Hello and welcome back to the ROI channel, the channel that's obsessed with all things to do with the art and science of return on investment. Today, got a very exciting opportunity to go over. It's our biggest UK company holding in the Crassus portfolio, and that is Royal Mail. Okay, so air freight and logistics company. Thank you to all those who have added the eToro portfolio to your watch list. If you haven't done so, click in the link below and you can check the fund out and add it to a list and keep an eye on how it's doing. Or if you've got funds and you want to rock and roll, you can press the copy function and your investments will be distributed as of the weightings of the company portfolio at the time. Thanks for all the subscribers in YouTube. If you haven't liked and subscribed, I would greatly appreciate that. It helps me to get the word out there. And I will answer a few questions at the end that we've been getting on the YouTube channel. So without further ado, let's get into today's stock review. As always, we use the Crassus investment formula when analyzing companies that may be potential fits for the portfolio. And we're looking for companies with low debt, margin of safety, sales growth, strong margins, free cash flow growth in particular, and ideally share buybacks. If we can have free cash flow growth, share buybacks and multiple expansion or investors wanting to pay more for those particular cash flows because they're growing, then that's the holy trinity of investing. We're going to get some twin turbos or triplet turbos working in our favor. So, okay. Royal Mail, we're talking Great British Pounds, okay? Couldn't work out the pound symbol, sorry guys, so just put GBP in there. Revenue announced 12.6 billion for 21 fiscal year. It's already ended. They're on their fiscal 2022 year now. 5% compounded annual growth rate historically. EBITDA 1.25 billion and a 10% compounded annual growth rate. This is an old school company, a stalwart. It's very dominant in the space. They're taking over more and more with I believe they're looking at acquisitions of ways that they can increase their footprint in the space in which they operate. So to be able to have 5% top line growth and expanding the margins by growing the EBITDA at a faster pace, that's a really good sign. Market cap 4.87 billion, I believe, and 5.35 billion enterprise value. Price as of recording is £4.87. Shares just under a billion. Been flat on the stock. Buyback. They did buy back about £3 million worth, but not too much, just to bring it under £1 billion, it looks like. What they did last year, though, was pay down, I believe, around £888 million in debt. Okay, so the company is virtually debt-free now, has a lot of cash on the balance sheet, and so we as investors could have great optionality on that cash in a business that's a dominant player in the industry, a stalwart that has had decent growth in both the sales and the margins. So that's interesting. They pay a small dividend, 1.9%. Return on capital is quite decent at 14%. Net debt to EBITDA, as I said, less than 1. So that's no problem whatsoever. Very solid balance sheet. A couple of key points. The book value of this company, meaning the assets minus the liabilities, if you were to liquidate the company today, is around about £4.79 per share. So we're basically buying it at more or less the book value of the company, which is dirt cheap in my opinion. CapEx is around 289 million sustainably. So that's the amount that they have to continue to put back into the business for the operating aspects of the business. And cash on hand is around 1.5 billion pounds. So with the market cap at around 4.5 billion pounds, they can easily buy back a quarter of the company. So tomorrow they could turn around and say, what do we do with this cash? I don't know. Can't seem to buy another business. We haven't really got another product or service to add on and develop through R&D. So, you know what? We pay off the CapEx and we still got a heap of cash. Let's buy back 25, maybe even 30% of the shares on the open market and tear that up. Okay, so our claims on the cash flow would grow by that corresponding amount. They'd essentially have a reduction in a quarter of the other shareholders. So that's one of the, I'm not saying they will do this, but that's one of the things that the company could do. And if they're shareholder minded, they'll at least put out a decent chunk of that cash to buying back their shares, which will reward us greatly as shareholders. So very, very important to look at. This company's trading for basically liquidation value. It's with the cash that it's got, able to pay out its capex, maintain its business, and could easily buy back, maybe a quarter of the shares outstanding, conservatively speaking, and continue to operate and grow into the future. So very, very exciting. And I think that people were starting to realize how underappreciated the company was, certainly last year, where if we look at the year to date, the price has gone haywire. It's added a 101.6% over where it was trading towards the end of 2020. So price movement has cooled off recently, which could be a very good opportunity for us to enter, but it's taken off over the past 12 months. Okay, so here we got dollar signs, but it's actually pound. Okay, so everything was worked out in Great British pounds. As I said, fiscal 21 is done for them, so we're looking out at estimates for 2023, and free cash flow is expected to come in about £1 per share, and that's not allowing for any potential buybacks. Okay, so it could be a hell of a lot more. EBITDA on a per share basis and earnings per share there, you can read those, and applying the median multiple. So I am banking on a bit of multiple expansion here. However, the multiples at which Royal Mail is currently trading is so far below, it's insane. So they're trading at less than 10 times the free cash flow, I believe. They're also, 13.5. I just looked at it before. Their enterprise value to EBITDA is, I think, less than 4, and their PE is much lower than 16. So they're trading a long way below their competitors at their multiples. And in fact, if you jump on the internet, I would encourage you to look at the European counterparts. So you've got a lot of the German ones. There's Deutsche Post, Österreich Post, that's if you don't speak German, that's Austrian Post. There's the Portuguese one, Correios de Portugal, I believe. Anyway, so they're all trading at these industry median multiples, and so I think that just getting up to par would add tremendous lift to the share price. Not only are they going to have decent numbers in terms of the earnings and cash flows, but I think investors are going to be willing to pay a lot more and bid up the price. So it may not happen, but if it gets anywhere near just the median, we're in for quite an upside. So these are the implied share prices as a result of multiplying the given inputs by the industry median, and you can read those through there. Not going to read them out to you. And divide those up, weighting them evenly, we get an average price £10.80. Okay, so that's about more than a double, 220% on the upside in about 18 months is really good. Okay, we'll take that every day of the week for a company that has no debt, that can buy a quarter of its market cap back tomorrow with the cash that it has on hand. And what more can I say? It's a really exciting opportunity. Not necessarily the most exciting company. It's just a freight and logistics company, but hey, it's set for growth, and it's good value. So what more can we ask for? So let's see, if we buy the shares today at the price, remember that is in pounds, it's not the US dollar equivalent. I know it's a bit confusing, but I just thought I'd make that abundantly clear. And these are the cash flows that we expect based on historic growth rates. This is the EBITDA per share value, and we exit, say, year 10 at the historic median enterprise value to EBITDA, so the historic multiple, discounted back at the company's weighted average cost of capital, and we're looking at an IRR, or an annualized, think of it as an annualized return. I know it is a little bit different to be technical, but basically an annualized return at 23%, which is awesome. Okay, it's comfortably above our 20% target that we look for. If I do the same thing with the free cash flow per share, and we are looking at around $24 IRR, which is fantastic. That will beat the market in just about any year that you care to choose. Okay, fleshing it out a little bit more, looking at earnings, EBITDA, and free cash flow inputs. We've got our base case, bull case, and bear case. And I've used historic growth rates and historic multiples for the base case, as I always do. for each of those. This is the EBITDA case. I've done the same thing for the free cash flow and the earnings, and you'll see the intrinsic value down there. And I've said, okay, we want our discount rate at 20%, which is our target rate of return. And so if we plug into that formula, we apply probability weightings to those scenarios. For here, what I've done is provided an 80% probability that past is prologue for the company. I happen to think that the next 10 years are going to be much better for the company than they were before. But given the type of business that it is, its susceptibility to disruption is very low. Its risk is very low. It's a marathon runner. It's a slow churner. So 80% probability, and then 10% for outlying scenarios on the tail ends there. So bear and bull case. We get an intrinsic value of £10.48. So if we want to get a 20% annualized return on this company, assuming these inputs will play out in the future, we can buy the shares for £10.48 or less and receive our investors' required rate of return. If we add a margin of safety on top of the average of all three, so these are the intrinsic values for the different inputs, EBITDA, free cash flow, and earnings per share. And we say, okay, can we get a margin of safety of 66%? So that's 2/3 the value of what we believe they're worth. We come to £6.77. So that there is saying that we are potentially looking at a really good opportunity into the future. It's well priced. It's a great company. It's got all the things that we look for. And so I'll be buying it and continuing to buying it. It's currently about 4% of assets under management, and I'll be looking to get it potentially to 5%. Okay, that's how much I really appreciate the upside potential for this company. Thanks for watching. If you haven't liked or subscribed to the YouTube channel, please do. It does help me out quite a bit. And if you are interested in either copying or just following the portfolio and see how it does, click on this link, updated link, and I'll leave it in the description. And you can just add it to your watch list and keep a track on how things are going. A few questions that I have been getting, I have answered them on the YouTube channel. One was about Gazprom. And the gentleman was asking at what price would I believe Gazprom, would I sell Gazprom? And so if you look at it, Gazprom at last look was still trading with a double-digit dividend yield on the price, okay? So around about 10% yield. The norm for Russian oil stocks, I believe, is around about 7% yield. So I think you're going to start to see that yield come down as the price keeps powering out. They are printing a ton of cash. Based on natural gas prices. So for me, that would leave Gazprom, if it was above, let's say $15 per share, we'd be in for nearly a double, and so I would start to trim back the position, okay? And the further it started to run, then I'd be looking to exit. If it got to a 5% yield, I'd probably look to exit the position and roll that capital into another opportunity. All right. Thank you very much for watching. As always, do your due diligence. It's only sensible, and I wish you all the best with your investments. Don't just take what I say as gospel by any means. This is just my opinion, and it could be wrong, or I could change my mind based on the information. So always do your due diligence, and I'll see you in the next video.